Hi, and welcome to our Stock Option Tax Project presentation for Business 433A Individual Taxation, presented by
Samantha Ballier,
Meg Dumke,
Luke Legoski,
and Michael Meehan. Before we dive into stock options and the terminology and the different kinds of stock options, let's start by talking about a brief history and the purpose of stock options. Stock options were first used in the 1940s and 50s as a bonus for key executives in the United States. Until the 1980s and the rise of Silicon Valley, stock options were exclusive to a firm's top management, with Silicon Valley fostering startup companies who were low in cash and had no profits yet. Many firms used employee stock options in order to pay their employees as a promise of future gains based directly on the success of the company. Another reason why stock options became very popular among startup companies is they increased worker loyalty and improved morale because the success of the company was now directly connected to the performance of every individual employee. Now, there is a lot of confusing terminology, and I want to address some of the major ones. First, when a firm gives you a stock option to buy a stock at a fixed price for a certain number of years in the future, this is called the grant price. This can also be called the exercise price or the strike price. This price never changes regardless of what the fair market value is. You are hoping that the price will increase in the market so you can exercise the option or buy the stock at your lower price and then sell it at the higher price in the market. The difference between the exercise price and the market value is called the bargain element. Companies set limits as to how soon you can buy your options. These limits are called vesting restrictions and typically require you to work for a certain number of years before you can exercise them. Now, there are different types of vesting restrictions. One of these is called straight vesting, in which the same percentage of options can become exercisable each year. So for example, if you had a 4-year vesting period and options to buy 2,000 shares, 500 options, or 25%, would vest each year. Another type of vesting is called cliff vesting, in which all of your options become exercisable at one time or at one date. A third type of vesting is called performance vesting, which means that your options would vest in the year that your company achieves a particular goal, such as a certain level of revenue, higher share price, or a certain amount of sales. The last type of vesting is called step vesting, where the percent of options each year varies from year to year. There are also things called lockup agreements that prevent you from selling your shares until a specified time once you've purchased them.
In this section, we talk about employee and employer considerations for stock options. The two types are non-qualified stock options, called NQOs, or incentive stock options, called ISOs. They differ in terms of when and how the bargain element is taxed. When non-qualified stock options are exercised, employees report ordinary income equal to the total bargain element on the shares of stock acquired, as if they were sold, whether they hold the shares or sell them immediately. A taxpayer's basis in non-qualified options acquired is the market value on the date of exercise. So if the basis includes the exercise price plus the ordinary income, the taxpayer recognizes that on the exercise date. When incentive stock options are exercised, employees don't report any income for regular tax purposes, as long as they don't sell them immediately. The exercise price is the basis for incentive stock options. When taxpayers exercise incentive stock options, the bargain element is added to their alternative minimum taxable income, which will increase the likelihood that taxpayers will be required to pay the alternative minimum tax. The holding period for stock shares acquired with non-qualified stock options and incentive stock options begins on the exercise date. In this section, we talk about what happens once options are exercised. For non-qualified stock options, employees who purchase stock with non-qualified stock options and retain that stock are in the same position for tax purposes as any other investor. Their basis in the stock is the fair market value on the date they exercised the options, and any future appreciation or depreciation of the stock will be treated for tax purposes as either short or long-term capital gains or losses, depending on the holding period. To avoid overweighting their investment portfolios with a single stock, employees exercising non-qualified stock options often immediately sell all or a big amount of their shares acquired on the exercise date. This is known as a same-day sale. This is for incentive stock options. Employees who acquire shares through the exercise of incentive stock options also have an additional tax benefit. If they hold such shares for at least 2 years after the grant date and 1 year after the exercise date, they will not be taxed until they sell the stock. So once they sell the stock, employees will treat the difference between the sale proceeds and the tax basis or exercise price as a long-term capital gain in the year of disposition. Therefore, employees prefer IOSs to NQSs. This slide talks about the employer considerations for stock options. For non-qualified stock options, employers can deduct the bargain element that employees recognize as income when the employees exercise the NQOs. For incentive stock options, employers don't typically view ISOs as favorably as NQOs because first, ISOs don't provide them with the same tax benefits, as in no tax deduction. Number two, the IRS regulatory requirements for IOSs can be complicated.
So now we're going to talk about some of the significant internal revenue codes that relate to non-qualified stock options and incentive stock options. To begin with, we have Internal Revenue Code Section 430, which is minimal funding standards for single employer defined benefit pension plans. Some of the highlights of this code are minimum required contribution, target normal cost, special election for eligible plans, and increases in alternate required installment in cases of excess compensation or extraordinary dividends or stock options. Next, we have Internal Revenue Code Section 3231, which outlines some basic definitions such as employer, employee, compensation, and treatment of certain deferred compensation and salary reduction arrangements. Now I'm going to talk about some of the relevant codes for incentive stock options. To begin with, we have Internal Revenue Code Section 421A, which outlines some of the general rules. And then we get into Internal Revenue Code Section 422, which more specifically defines stock options and provides that no disposition of such share is made within 2 years from the date of granting of the option, nor within 1 year after the transfer of such share. And the individual must remain an employee of the corporation at all times during the period beginning on the date the option was granted to him and ending on the day 3 months before the exercise of his options. Now we have Internal Revenue Code Section 422 D1, which provides that the aggregate fair market value of the stock with respect to the incentive stock options that are exercisable for the first time by any individual during the calendar year that exceed $100,000 shall be treated as options and not incentive stock options. And then we have Internal Revenue Code Section 422 C2, which talks about disqualifying dispositions, and I'm going to cover that a little more on the next slide. So what effect do disqualifying dispositions have on the incentive stock options? If the 2-year and 1-year requirements are not met, the premature sale of the stock is classified as a disqualifying disposition, and the bargain element is taxed at the time of sale as if the option had been a non-qualified option. When holders of ISOs execute same-day sales, they forgo the benefit of taxing the bargain element at lower capital gain rates, but they do eliminate the investment risk they would otherwise have to bear if they attempted to satisfy the 2-year and 1-year holding requirements. In case of a disqualifying disposition, such as not meeting the time requirements, gain on a sale is considered to be ordinary income. The ordinary income reported is the fair market value of the stock when exercised less the exercise price. Now I'm going to talk about incentive stock options and the effect they might have on your alternative minimum tax. So let's say you decide to exercise your options to purchase shares and hold on to them. You're going to have to make an adjustment for the alternative minimum tax that equals the bargain element, but no income shall result at the transfer of the shares to the individual upon his exercise of those shares. Although you have triggered an AMT liability in the year you exercise your option, you will also generally earn an AMT credit that can be used to lower your tax bill in ensuing years. And now if you exercise your option to purchase shares and then sell within the same calendar year, because you exercised your options and sold the stock in the same calendar year, you do not need to make an adjustment for AMT purposes. Although you will not be subject to AMT, you would be subject to regular tax on the difference between your option exercise price and sales price.
Another form of stock is restricted stock. Similar to stock options, they cannot be sold, traded, or otherwise treated as property of the employee until the vesting date when they legally gain the right to the shares. The main difference between restricted stock and traditional stock options is the amount paid when the stock is received. Employers receive the fair market value for restricted stock on the vesting date, but do not have to pay anything for the stock itself. Restricted stock is taxed similarly to non-qualifying stock options, with an important difference. Because the employee received the value of the stock without making any payment for the stock, the employee has no basis in the stock. Thus, the full fair market value is taxable as ordinary income on the date the restricted stock vests. After the vesting date, the employee can choose to sell the stock immediately or hold it for a longer period. The holding period begins on the vesting date, and depending on the length of the holding period, any gain or loss upon disposition will be treated as either long-term or short-term capital gains or losses. When dealing with restricted stock, there is an option to make an 83B election. This option is available until 30 days after the grant date. It is irrevocable and has significant tax consequences. While the restricted stock is usually taxable on the vesting date, if the employee makes the 83B election, the value of the restricted stock will be taxable on the grant date instead of the vesting date. This election accelerates the taxes payable on the fair market value of the restricted stock. As a tax planning strategy, delaying taxes incurred is usually preferable. Although, if the fair market value of the stock is expected to grow considerably, this option may be advisable. Making the election will transfer ordinary income into long-term capital gains. However, if the election is made and for any reason the stocks are forfeited, the employee cannot deduct the loss on the forfeiture. Accordingly, the risk in selecting the 83B election is that the employee may end up paying taxes on value that was never received if the employee forfeits the stock. Thank you for listening to our presentation on stock options relating to the relevant tax implications and consequences. On behalf of Mike Meehan, Luke Legowski, and Samantha Ballier and myself, we would like to thank Terry Lease for a wonderful semester.